Question 1. Policy provisions and causes. Which of the following statements best describes the contestability period in a term life insurance policy? A. The insurer cannot contest a claim for any reason after the policy has been in force for 2 years. B. The insurer can contest the validity of a policy for any misrepresentation made by the insured, regardless of when it occurs. C. The contestability period lasts for 1 year and applies only to suicide claims. D. The contestability period allows the insurer to investigate claims made within the first 2 years of the policy, including for fraud. Answer: D. Explanation. The contestability period is a specific duration, typically 2 years, during which the insurance company can investigate and contest the validity of the policy based on material misrepresentations or omissions made by the insured in the application. This means that if a claim is made within this period, the insurer has the right to conduct a thorough review and potentially deny the claim if fraud is suspected. After this period, claims cannot generally be contested based on statements made in the application unless there is clear evidence of fraud. This provision is outlined in Maine insurance regulations to protect both the insurer and the insured, ensuring transparency and fairness in the insurance contract. Question 2. Premium calculation and factors influencing rates. In calculating the premium for a term life insurance policy, which of the following factors is AST likely to affect the underwriting decision? A. The applicant's occupation and associated risks. B. The applicant's marital status. C. The applicant's smoking habits. D. The applicant's medical history. Answer: B. Explanation. When underwriting term life insurance, insurers assess various factors that influence the risk profile of the applicant. Factors such as occupation, A, smoking habits, C, and medical history, D, significantly impact the risk assessment and, consequently, the premium. High-risk occupations and habits increase the likelihood of claims, leading to higher premiums. However, marital status, B, is generally not considered a primary factor in underwriting decisions. It does not directly correlate with the applicant's health risks or mortality rates. Thus, while it may influence some aspects of financial planning, it is the least likely to affect the underwriting decision. Question 3. Scenario question. Mr. Thompson has recently purchased a term life insurance policy with a level premium for a 20-year term. A year later, he learns he has been diagnosed with a serious medical condition that could affect his life expectancy. Considering the implications of the policy's provisions, what should Mr. Thompson consider doing regarding his insurance coverage? A. Cancel the policy immediately to avoid higher premiums in the future. B. Keep the policy as is, since it cannot be affected by his health condition due to the level premium structure. C. Contact his insurer to discuss converting his policy to a permanent life insurance policy. D. Increase his coverage amount now before any further health complications arise. Answer: C. Explanation. In this scenario, Mr. Thompson should consider option C, to contact his insurer regarding the possibility of converting his term policy to a permanent life insurance policy. Many term policies offer a conversion option, allowing the policyholder to switch to a permanent policy without undergoing additional medical underwriting, which can be critical after a health diagnosis. Option B may seem attractive because the level premium structure keeps his payments consistent. However, it does not address potential future needs if he becomes uninsurable due to his health. Options A and D are not advisable. Cancelling the policy could leave him without coverage, and increasing coverage could lead to higher premiums or denial based on his new health condition. Understanding the conversion option aligns with Mr. Thompson's best interests to maintain coverage while navigating his health challenges as per Maine's consumer protection regulations. Question 4. Premium calculation and factors influencing rates. Which of the following factors would most likely lead to an increase in the premium for a term life insurance policy? A. The insured's age at the time of policy issuance. B. The insured's decision to switch to a semi-annual payment plan. C. A policy that includes a waiver of premium rider. D. The insured's participation in a regular physical fitness program. Answer A. The insured's age at the time of policy issuance. Explanation. Age is one of the primary factors influencing life insurance premiums. As individuals age, the risk of mortality increases, leading insurers to charge higher premiums for older applicants. While switching payment plans, B, may alter the administrative costs, it does not inherently increase the risk. A waiver of premium rider, C, adds coverage and can increase premiums, but only if activated. Participation in physical fitness, D, generally lowers health risk, potentially reducing premiums. Thus, the correct answer emphasizes the direct relationship between age and mortality risk. Question 5. Claims process and settlement. In Maine, when an insurance company receives a claim for a term life insurance policy, which of the following actions must the insurer take within 30 days? A. Provide the claimant with an acceptance or denial of the claim. B. Initiate an investigation into the cause of death. C. Request additional information from the claimant. D. Notify the beneficiaries about the claim status. Answer A. Provide the claimant with an acceptance or denial of the claim. Explanation. Maine regulations stipulate that once a claim is filed, the insurance company is required to inform the claimant of their decision to accept or deny the claim within 30 days. This is a consumer protection measure aimed at ensuring timely communication. While initiating an investigation may be part of the process, the insurer must still provide a decision within the specified time frame. Requesting additional information can occur but must not delay the initial claim decision. Notifying beneficiaries D is good practice but not specifically mandated within the 30-day period. Question 6. Policy provisions and causes. Which of the following provisions allows a term life insurance policyholder to reinstate their policy after it has lapsed due to non-payment of premiums? A. Grace period. B. Reinstatement clause. C. Contestability period. D. Exclusions clause. Answer. B. Reinstatement clause. Explanation. A reinstatement clause is a provision that allows policyholders to restore a lapsed policy by paying overdue premiums within a specified time frame, typically within 3 to 5 years from the lapse. The grace period A is the time allowed for premium payment before the policy lapses. The contestability period C refers to the time frame during which the insurer can contest a claim based on misrepresentation. Exclusions D are specific circumstances under which the insurer will not pay a claim. Understanding these causes is vital for consumers to maintain their coverage. Question 7. Theoretical knowledge. In risk management principles, which of the following best describes the purpose of term life insurance? A. To transfer risk away from the policyholder to the insurer for a specific period. B. To accumulate cash value over time for the policyholder's future use. C. To provide tax-deferred growth on the death benefit. D. To act as a financial investment with guaranteed returns. Answer A. To transfer risk away from the policyholder to the insurer for a specific period. Explanation. The primary purpose of term life insurance is to provide financial protection by transferring the risk of death from the policyholder to the insurer for a specified term. Unlike whole life policies, term life does not accumulate cash value. B. Or provide tax-deferred growth. C. It also does not function as a financial investment. D. With guaranteed returns. By understanding the core function of term life insurance, policyholders can make informed decisions about their coverage needs. Question 8. Practical applications. Which of the following scenarios best demonstrates the need for a policyholder to reassess their term life insurance coverage? A. The policyholder has paid premiums for 10 years without incident. B. The policyholder's spouse has started a new job with a significantly higher income. C. The policyholder has received a promotion that includes an increase in salary but no additional benefits. D. The policyholder is considering taking out a mortgage for a new home. Answer. D. The policyholder is considering taking out a mortgage for a new home. Explanation. The decision to take on a new mortgage significantly alters a policyholder's financial obligations, necessitating a reassessment of life insurance coverage. The new debt increases the financial burden on the insured's dependents in the event of premature death, thus warranting higher coverage. While changes in employment and income, B and C, can influence financial situations, they do not inherently create new financial obligations like a mortgage does. Paying premiums for an extended period without incident A does not alone indicate a need for reassessment. Question 9. Unique aspects of term life insurance in Maine. What is a unique characteristic of term life insurance in Maine compared to other states? A. Low maximum death benefit limits imposed by state law. B. The mandatory provision of a conversion option to permanent insurance. C. A requirement for all policies to include a return of premium option. D. Specific regulations governing the advertising of term life insurance policies. Answer. B. The mandatory provision of a conversion option to permanent insurance. Explanation. Maine law requires that term life insurance policies offer a conversion option, allowing policyholders to convert their term policy into a permanent policy without evidence of insurability during the term. This is a consumer-friendly feature that provides flexibility as the insured's needs change. Other options listed do not reflect unique Maine regulations. For example, not all states impose limits on death benefits A, nor do they require return of premium options C, or specific advertising regulations D. Question 10. Ethical considerations in insurance practice. Which of the following actions by an insurance agent could potentially violate ethical guidelines in Maine? A. Disclosing all policy options and benefits to a prospective client. B. Failing to disclose personal commissions from policy sales to the client. C. Encouraging clients to review their existing coverage annually. D. Providing clients with information on policy exclusions. Answer: B. Failing to disclose personal commissions from policy sales to the client. Explanation: transparency and full disclosure are fundamental ethical obligations for insurance agents. Failing to disclose commissions B. constitutes a conflict of interest and can undermine trust. The other options: disclosing policy options A. Encouraging annual reviews C. And providing information on exclusions D. reflect ethical best practices that promote informed decision-making among clients. Understanding these ethical obligations is critical for maintaining integrity in the insurance profession. Question 11. Claims process and settlement. During the claims process for a term life insurance policy, what is the primary purpose of the contestability period? A. To ensure that beneficiaries receive the death benefit promptly. B. To allow the insurer to verify the policyholder's health status before payout. C. To provide a time frame for investigating the circumstances of the insured's death. D. To protect the insurer from fraudulent claims made within the first 2 years. Answer: D. To protect the insurer from fraudulent claims made within the first 2 years. Explanation: the contestability period is typically the first 2 years of a policy's term, during which an insurer can investigate and potentially deny a claim based on misrepresentations made by the policyholder in their application. This provision safeguards the insurer against fraud. Options A and C relate to the claims process but do not capture the primary purpose of the contestability period. While verifying health status B is important, it occurs during underwriting, not after a claim is filed. Question 12. Regulatory framework in Maine. Which of the following is a key responsibility of the Maine Bureau of Insurance? A. Setting insurance premium rates for all insurance products. B. Licensing insurance agents and brokers in the state. C. Determining the minimum coverage amounts for life insurance policies. D. Providing financial incentives to insurance companies to operate in Maine. Answer: B. Licensing insurance agents and brokers in the state. Explanation: the Maine Bureau of Insurance is responsible for licensing agents and brokers to ensure that they meet specific qualifications and comply with state regulations. While the Bureau oversees the insurance industry, it does not set rates A or determine minimum coverage amounts C for policies. There are no provisions for providing financial incentives D to insurers. Understanding the regulatory framework helps agents navigate compliance and consumer protection effectively. Question 13. Premium calculation and factors influencing rates. When calculating premiums for term life insurance, which of the following lifestyle factors is likely to lead to a higher premium? A. Participation in a high-risk hobby, such as skydiving. B. Maintaining a healthy diet and regular exercise routine. C. Having a stable job in a low-risk occupation. D. Being a non-smoker with no family history of illness. Answer 8. Participation in a high-risk hobby such as skydiving. Explanation: insurers evaluate lifestyle factors to determine risk levels. Engaging in high-risk activities like skydiving increases the likelihood of injury or death, leading to higher premiums. In contrast, maintaining a healthy lifestyle, B. Having a stable job, C. And being a non-smoker with no family history of illness, D. typically contribute to lower premiums. This question illustrates how individual behaviors and choices directly affect insurance costs. Question 14. Policy provisions and causes. Which of the following causes in a term life insurance policy specifies conditions under which a claim may be denied due to the policyholder's actions? A. Grace period. B. Suicide clause. C. Misstatement of age clause. D. Reinstatement clause. Answer: B. Suicide clause. Explanation: the suicide clause allows insurers to deny claims if the insured commits suicide within a specified period, usually 2 years from the policy's effective date. This clause is included to mitigate risk associated with premeditated death. The grace period A provides time for premium payment and the misstatement of age clause C addresses inaccuracies in age reporting, potentially altering benefits rather than outright denying claims. The reinstatement clause D relates to restoring lapsed policies, not claim denials. Question 15. Practical applications. Mr. Thompson is a 45-year-old father of two considering term life insurance. His wife recently became a stay-at-home parent and they have a mortgage of $250,000. What factors should Mr. Thompson primarily consider when selecting a policy? A. His age and health status only. B. The length of the mortgage and future financial obligations. C. The type of policy and premium payment frequency. D. The insurance company's advertising reputation. Answer: B. The length of the mortgage and future financial obligations. Explanation: Mr. Thompson should focus on the length of his mortgage and any future financial obligations, such as his children's education, to determine how much coverage is necessary to protect his family. While age and health are important, they are secondary to understanding financial needs. The type of policy and payment frequency C are considerations but less critical than ensuring sufficient coverage. The company's advertising reputation D does not directly influence the adequacy of the coverage. Question 16. Critical thinking abilities. When evaluating the financial health of an insurance company, which of the following indicators is most critical? A. The company's advertising expenditure. B. The company's claims paying ability ratio. C. The number of agents employed by the company. D. The geographical regions the company operates in. Answer: B. The company's claims paying ability ratio. Explanation: the claims paying ability ratio is a crucial indicator of an insurer's financial strength, reflecting its capacity to meet policyholder claims. Advertising expenditure may indicate marketing strategies, but does not reflect financial health. The number of agents C can vary and doesn't correlate directly with financial stability, nor does the geographical reach D. Agents should assess insurers based on objective financial metrics. Question 17. Theoretical knowledge. In the context of life insurance, what is meant by the term of time value of money? A. Money available now is worth more than the same amount in the future due to its potential earning capacity. B. The total amount of premium paid over the life of the policy. C. The age of the policyholder at the time of policy purchase. D. The expected growth of the death benefit over time due to interest accumulation. And so, hey, money available now is worth more than the same amount in the future due to its potential earning capacity. Explanation: the time value of money is a financial principle stating that a dollar today has more value than a dollar in the future because it can earn interest or generate returns. This concept is critical for understanding how insurance products are priced and evaluated. The total premiums B do not directly relate to time value. Age C and expected growth of the death benefit D are separate considerations and not reflective of this financial principle. Question 18. Unique aspects of term life insurance in Maine. Which of the following statements is true regarding the specific regulations affecting term life insurance policies in Maine? A. All term life insurance policies in Maine must provide a death benefit equal to at least 5 times the annual premium. B. Maine law requires that term life insurance policies include an option for policyholders to convert to whole life insurance. C. The maximum age for purchasing a term life insurance policy in Maine is capped at 70 years. D. Insurers in Maine are not required to provide a grace period for premium payments. Answer: B. Maine law requires that term life insurance policies include an option for policyholders to convert to whole life insurance. Explanation: Maine mandates that term life insurance policies provide an option for conversion to whole life insurance, ensuring flexibility for policyholders as their needs evolve. The statement regarding death benefits is incorrect. There are no fixed ratios. There is no maximum age for policy purchase. C. That applies broadly, and Maine insurers must provide a grace period. D. To allow for late premium payments. Understanding these unique aspects aids consumers in navigating local insurance offerings. Question 19. Additional considerations. Which of the following tax implications is generally associated with term life insurance policies? A. Premiums paid are tax deductible for individuals. B. Death benefits paid to beneficiaries are generally tax-free. C. Cash value accumulation is subject to income tax. D. The policyholder must pay capital gains tax on premiums. Answer: B. Death benefits paid to beneficiaries are generally tax-free. Explanation. In most cases, death benefits received by beneficiaries of a term life insurance policy are not subject to federal income tax, making them a tax-efficient way to provide for dependents. Premiums paid are not tax-deductible for individuals unless the policy is part of a business expense. Cash value accumulation C is not applicable to term policies as they do not accumulate cash value. Capital gains tax on premiums D is not a standard requirement as premiums are not considered income-producing investments. Question 20. Ethical considerations in insurance practice. Which of the following actions would most likely be considered an unethical practice by an insurance agent in Maine? A. Offering a client a free policy review every year. B. Pressure selling a policy without fully disclosing its terms and conditions. C. Providing clients with comprehensive information about various policy options. D. Encouraging clients to consider additional riders for their policy. Answer. B. Pressure selling a policy without fully disclosing its terms and conditions. Explanation. Pressure selling tactics that omit full disclosure of policy terms are considered unethical as they can lead to misinformed client decisions. Offering free policy reviews A and providing comprehensive information C are positive practices that promote transparency. Encouraging additional riders D can be beneficial if done ethically, highlighting the importance of informed client choices. Understanding ethical practices is crucial for maintaining trust and integrity in the insurance industry. Question 21. Understanding policy types. Which of the following best describes a term life insurance policy? A. It provides coverage for the entire lifetime of the insured. B. It offers coverage for a specified period and pays a death benefit only if the insured dies during that term. C. It accumulates cash value over time that can be borrowed against. D. It pays a benefit if the insured is diagnosed with a terminal illness. Answer. B. It offers coverage for a specified period and pays a death benefit only if the insured dies during that term. Explanation. Term life insurance is designed to provide a death benefit for a specific period, typically ranging from 1 to 30 years. If the insured dies during this period, the beneficiaries receive the benefit, otherwise, the policy expires without value. Options A and C describe whole life policies, while D pertains to specific riders or benefits that may not be included in standard term policies. Question 22. Riders and options. Which of the following riders allows the policyholder to increase their coverage amount without undergoing additional underwriting? A. Waiver of premium rider. B. Accidental death benefit rider. C. Guaranteed insurability rider. D. Cost of living rider. Answer. C. Guaranteed insurability rider. Explanation. The guaranteed insurability rider allows policyholders to purchase additional coverage at specified times without having to provide evidence of insurability, typically triggered by life events like marriage or the birth of a child. The waiver of premium rider A provides relief from premium payments in case of disability, while the accidental death benefit rider B pays an extra benefit for death due to accidents. The cost of living rider D adjusts coverage for inflation but does not allow additional coverage without underwriting. Question 23. Underwriting considerations. During the underwriting process for a term life insurance policy, which of the following factors is least likely to be considered? A. The applicant's medical history. B. The applicant's credit score. C. The applicant's lifestyle choices. D. The applicant's occupation. Answer. B. The applicant's credit score. Explanation. Underwriting typically focuses on the applicant's health history, lifestyle, such as smoking or risky hobbies, and occupation to assess risk and determine premiums. While financial stability can be relevant for certain insurance products, credit scores are not usually a primary factor in underwriting term life insurance. This differentiation highlights the importance of health and risk assessment in the underwriting process. Question 24. Policy lapsing. If a term life insurance policy lapses due to non-payment of premiums, what is the typical recourse for the policyholder? A. The policyholder can automatically reinstate the policy without any conditions. B. The policyholder may apply for reinstatement within a specified period, usually requiring proof of insurability. C. The policyholder loses all benefits and cannot reinstate the policy under any circumstances. D. The policyholder receives a partial refund of premiums paid. Answer. B. The policyholder may apply for reinstatement within a specified period, usually requiring proof of insurability. Explanation. Most term life insurance policies allow for reinstatement after a lapse, often within a specified time frame, provided the policyholder can demonstrate insurability. Automatic reinstatement A is not typical, losing benefits completely. C is not accurate since reinstatement options exist, and partial refunds of premiums. D generally do not occur in such cases, especially for term policies, which typically do not accumulate cash value. Question 25. Premium payments. Which of the following statements about premium payments for term life insurance is true? A. Premiums are generally lower for term life insurance compared to whole life insurance. B. Premiums for term life insurance are guaranteed to remain the same for the life of the policy. C. Premiums can only be paid annually and not on a monthly basis. D. Premiums are tax deductible for personal income tax purposes. Answer A. Premiums are generally lower for term life insurance compared to whole life insurance. Explanation. Term life insurance typically has low premiums than whole life insurance because it does not accumulate cash value and is designed to provide coverage for a limited time. Premiums may be level for a specific term but can increase upon renewal or after the level term ends. B. Payments can be made monthly or annually. C. And premiums for personal life insurance are generally not tax deductible. D. Question 26. Conversion options. A term life insurance policy typically includes a conversion option that allows the policyholder to A. Convert the term policy into a permanent life insurance policy. B. Change the beneficiary of the policy without restrictions. C. Alter the coverage amount at any time. D. Exchange the policy for a different type of insurance product. Answer A. Convert the term policy into a permanent life insurance policy. Explanation. The conversion option allows policyholders to change their term life insurance into a permanent policy without undergoing additional medical underwriting, thus ensuring coverage continuity as needs evolve. Changing the beneficiary. B. Does not require conversion. Altering coverage amounts. C. Is not typically allowed in a term policy, and exchanging for a different product. D. Is not a standard feature. Question 27. Beneficiary designations. Which of the following is true regarding beneficiary designations in term life insurance policies? A. Only family members can be named as beneficiaries. B. The policyholder can change beneficiaries at any time without notifying them. C. The death benefit is always payable to the estate of the insured. D. A contingent beneficiary has the same rights as a primary beneficiary. Answer B. The policyholder can change beneficiaries at any time without notifying them. Explanation. Policyholders typically have the right to change beneficiaries without needing to inform them, providing flexibility as personal circumstances change. While family members are commonly named, there are no restrictions against naming others. The death benefit is not always payable to the estate. C. If a beneficiary is designated contingent beneficiaries. D. Have rights only if the primary beneficiary cannot claim the benefit, not the same rights as primary beneficiaries. Question 20. Exclusions in term life insurance. Which of the following situations would most likely be excluded from coverage in a term life insurance policy? A. Death due to a car accident. B. Death resulting from a pre-existing medical condition not disclosed in the application. C. Death by natural causes after the contestability period has passed. D. Death occurring while the policyholder is overseas. Answer B. Death resulting from a pre-existing medical condition not disclosed in the application. Explanation. If a policyholder fails to disclose a pre-existing medical condition during the application process and that condition leads to death, the insurer may deny the claim due to material misrepresentation. Deaths from accidents A. Natural causes post-contestability. C. And while overseas. D. Are generally covered unless specific exclusions apply, which is less common. Question 29. Policy customization. Which of the following additional benefits can typically be added to a term life insurance policy? A. Cash value accumulation. B. Chronic illness rider. C. Guaranteed interest return on premiums paid. D. Automatic premium loan provision. Answer B. Chronic illness rider. Explanation. A chronic illness rider allows for the early disbursement of the death benefit if the insured is diagnosed with a chronic illness, providing financial support during challenging times. Term life insurance policies do not accumulate cash value. A. Do not guarantee interest returns. C. And typically do not have automatic premium loans. D. As these features are more common in whole life insurance. Question 30. Ethical selling practices. Which of the following practices is considered ethical for insurance agents when selling term life insurance? A. Using high-pressure tactics to close sales quickly. B. Providing clear explanations of policy terms and conditions. C. Exaggerating the benefits of the policy to increase sales. D. Offering gifts to potential clients to encourage them to purchase policies. Answer: B. Providing clear explanations of policy terms and conditions. Explanation: ethical selling practices require agents to transparently explain policy details, ensuring clients can make informed decisions. High-pressure tactics, say an exaggeration of benefits, C. Mislead clients and violate ethical standards. Offering gifts, D. Can create conflicts of interest and may violate regulations against inducements in insurance sales. Understanding ethical practices fosters trust and long-term client relationships in the insurance industry.